So Josh, I'll let you introduce yourself first, but obviously this is a conversation about the M&A landscape because there's been a lot of activity in the last 12 months, a lot of interesting companies, and suddenly ad tech has become really sexy. It actually was being bashed around the place quite aggressively by various VCs, etc. You know, dumb money flew out of the VC market for ad tech, but there seems to be a lot of interesting stuff going on. So before we get into it, let me just give you a few minutes to introduce yourself and a bit about your firm.
Sure. And no fire taken from Julie Langley, who I used to work with at Jefferies.
She's a great lady.
Yeah. So I'm Josh Wepman. I'm a partner at GCA Advisors. We're a global investment bank headquartered in Tokyo with 14 offices around the world. In the U.S., we have about 100 bankers focused on TMT sector. I specifically spend my time focused on software and internet and really the intersection which has found its way into marketing and advertising. So I've represented a fair number of companies in the sector, sold to Interclick, sold to Invite Media, have worked on financings for MediaMath and for companies such as PubMatic and Bretroll in the old days, sold Video Plaza to Telstra. So we've been quite, and then most recently Xlate to Nielsen. So we're fairly active in the sector, I'd say among the most active.
So we've had a lot of deals this year, like hundreds of millions. Like we've had a lot of deals in the last 12 months. You know, why is the M&A market for ad tech so robust? What's sort of like just the broad strokes? Why do you think that there is a lot of activity in the market?
Yeah, I'd break it into sort of what I call a tale of two cities. I think there's a robust market in the sector for a couple of reasons. One is obviously for some players, some of the large strategic incumbents, this is a place where they understand they need to be. Digital is important. That's where the market's going. That's where a lot of their customers are deploying their budgets. They need to be playing in that. So that's the most obvious, but it's also probably the largest driver of activity. I'd say some of the other drivers of activity are some of the mid-sized players looking for growth, and whether that be new channels or scale, but making acquisitions for that purpose. And then I'd say that there's new players in the market who are focused on deploying or taking advantage of some of the assets they have, whether it's audience, whether it's data, whether it's mobile subscribers, all trying to leverage what they have as they fight for the part of the pie that's not being taken up by Facebook and Google. And so they're focused on acquiring some of the leading players in the space, and you're seeing some of the category leaders either being acquired or rumored to be acquired. And then there's the sort of, I'd say, sort of smaller also-rans who frankly are looking for homes, whether, I agree with a lot of what Julie said. I'm not sure I totally agree, at least here in the U.S., on the funding markets.
Right.
And so a lot of those players are realizing there is no next round.
Yeah.
And so they need to find a home. The VCs have been in there a while. And so better to become part of a larger player and maybe get liquidity down the road and sell for stock or sell for a lower price. But that's better than going to zero.
Do you think we're sort of in a cycle at the minute, right? So you have had a lot of investment in companies like AppNexus and MediaMath and PubMatic. So what we call and Rubicons of the world. Are we sort of in a cycle now where those companies need to sort of either have a liquidity moment, be bought or acquired, or go public? I mean, is that sort of propelling a lot of this?
Yeah.
As well?
I'd say there is a part of that. If you look at sort of the last round for a couple of those companies, whether it's AppNexus or MediaMath, right? They're not long-holding VC funds, right? They're the crossover funds who are usually looking for some sort of liquidity within 24 months, 36 months at the long side. And so, IPOs are being talked about again, and M&A as well. And for some of them, there's public companies, I think, from the last cycle that IPO'd for similar reasons, who are now for sale. And because IPO isn't necessarily a liquidity event; it's a liquidity event in part, but for some holders it may not be. And so some of those holders who, some of the VCs who are still in some of those public companies are looking for liquidity. And so you're hearing rumors about a number of those companies who are in the market trying to find, acquisition homes.
Yeah. Let's talk about the strategic buyers. Obviously, Yahoo and Google have just stopped spending money on ad tech, and Yahoo just basically spent a shit ton of money on ad tech and then got acquired by Verizon, obviously. But let's talk about the strategic buyers now in the space. I mean, you've got large media companies like Comcast, and you've got telcos like Telenor buying cross-device companies like Tapad, which was a bit of a weird one. I didn't really get that at all. But let's talk about sort of these new buyers.
Sure.
What's the sort of rationale, particularly the telcos, because they seem to be more active than most. I mean, the Verizon deal with AOL and Yahoo was pretty interesting, but they seem to be active, and the Singtels of the world buying so what's the rationale there? Just give sort of walk through, like, why is a telco buying ad tech?
Yeah, and
what do they need an ad server for?
And I might put a little bit of sunlight on Comcast, right? Who you didn't mention, but I think frankly have been among the most active, right? With having acquired Freewheel and Sticky, and a number of other, Visible World. So. They already own the platform, so they're out there as well. I wouldn't underestimate them. I mean, they've got a whole platform business now. But I think that there isn't an explanation writ large. I think that looking at Comcast or AT&T, who's rumored to Verizon, I mean, they've got some pretty unique assets they want to leverage, whether it be an audience and content where they can monetize through some of these acquisitions, whether it be the data that resides within their whole ecosystem. Yeah. And whether it be the mobile subscriber base, in a cookieless world of mobile, if they have subscriber IDs, that's a pretty valuable asset for them, and so that they can leverage. So I think that's a big driver of some of this. And then, coming out the other side of it is a new revenue stream, right? So a lot of the telcos, maybe not as much here in the U.S. because I think it's more fragmented, but if you look in some of the smaller markets, whether it be Telenor, whether it be Telstra in Australia, right, or Singtel, right, there is a finite number of subscribers, and there's only so much water you can wring from that towel. And so, how do they find growth? Well, maybe that's a new business, And so, whether it be Telenor with Tapad or Telstra with Uyala, right? They're trying to find new areas to grow their top line.
But do you think that telcos? I mean, it's interesting because telcos obviously sitting on a lot of first-party data, right? But their sort of track record in the advertising industry has been pretty crap. They haven't really had a glorified run. So I mean, are they committed to invest in these companies and building these businesses? I mean, like the people talked about the Verizon deal, but the reality is they've picked up two companies that make $7 billion, $8 billion, which are not it's a considerable sum every year. But do you think that the likes of Telenor, buying Tapad was interesting, but are they going to kind of build out a stack in those markets that are active? Like, so, they're in Norway, and then they've got like a subscriber base in Pakistan, and it's obviously a big growth market in advertising. Pakistan.
A lot of revenue coming through.
There is. But are these guys committed to this? Do you see those guys buying more assets and building and actually building teams around and actually building sustainable business there?
That's a great question. I think it's early days, so it's hard to be seen. I think that it's going to depend on the business. Telstra, I think probably not. They've already realized Uyala has not been as successful. They publicly wrote down 2/3 of the value, so they're probably not in there for the long haul. At least not in the current iteration. I think companies like Singtel probably are, right? They've committed, north of $1 billion for additional investment in the sector. I think so. I think they do think they are, but it also requires, and I think what Singtel has and is also searching for, it requires leadership, right? So you can't just buy something. You need to find something and find a leader if you're going to build around it. So. So it remains to be seen. I mean, they have the balance sheet to be able to do it, but you're right. I mean, they're used to predictable, profitable revenue streams, right? And so they're not used to something that can go to zero.
What about sort of the MarTech players? I mean, the Oracles of the world have, they've and Salesforce obviously acquired Crux there recently, $700 million. I mean, what's their sort of take on this? I mean, we have continuous conversations in the bars around London talking about MarTech. When are they going to buy an ad server? When are they going to buy an execution layer? Do you think like the DMP's a strategic buyer and that's as far as they're going to go in terms of like actually building out? Or will Adobe buy Adform? Or will Adobe buy an ad server? Or will a Salesforce get in buy a DSP? So in terms of their strategy, it just feels to me they're kind of dancing around the edges, right? Let's get a bit in here, but not all the way in. Do you see those guys moving more into the center, the execution layer, or are they finished?
Yeah, you're right. I mean, most of the activity for those players has been incidental, is the way I like to think about it, right? Blue Kai, they didn't buy it for, the advertising part of it. They bought for the DMP. So it's a great question, right? It's a different DNA. I mean, they're software businesses. They're used to recurring revenue. They're used to high gross margins, and not having to face the margin pressure that the media companies face, that the execution layer has historically seen. So that's going to be the challenge. I think as some of those execution layer businesses, as you call them, mature and try to mimic the model that the successful MarTech players have had with, whether it's trying to build a recurring revenue business. I think there's more of a likelihood. You've heard rumors for years that that Adobe is looking at a DSP or that Oracle is going to buy a DSP. We haven't seen it.
Is that like? Media is a messy business, We're
Right.
doing CPMs and it's not recurring income and it's not licensed, and they just don't want to pay license fees for business. They're prepared to work on a CPM basis and build that way. So I mean, is it our space, like the execution layer, as I call it, or the media business, is it too messy for a SaaS player, like to have to go to the stock or their stockholders and say we're going to spend $1 billion on
It may
unnamed
be,
DSP?
Yeah, it may be today, but I think that the model is going to evolve because what we've seen, if nothing else, is that those media models are hard to sustain. There's too many external pressures out there, whether, like I said, whether it be on margins or trying to find growth because it's so fractured. I do think that you're going to see some evolution in the model that may make them more attractive. But I think today, the talked about ad tech MarTech convergence is early. Yeah. I mean, if you're going to see it,
early.
If you're going to see it, it's not going to be. In my belief, it's not going to be from one of the SaaS players.
Who do you think it's likely to be from?
I think it may look. I think, frankly, going back to Comcast, you've seen it there, right? They own businesses that are more SaaS-like Freewheel, but they also own Sticky. Yeah. So you are seeing them piece together some of the pieces of the puzzle.
So it's interesting that you mentioned that I know we're going to talk about programmatic TV at some stage today, but that seems to be the big one. And these guys are particularly trying to ring fence their existing media businesses, like from the Facebooks, the Snapchats, the Googles of the world. So they're the ones who actually feel threatened, and the media is close to their business, so they're more likely to buy more tech, effectively.
Yeah, I think that's right. I do believe that they're seeing some threats to their business, and that they will be trying. I think a lot of the telcos, or a lot of the folks like a Comcast or an AT&T, who sort of bridge it all. I do think they're going to be trying to build some of that. And you're right. I think it is a bit defensive, and they will focus mostly on programmatic TV. The pieces they buy may have come from other worlds, but the thesis is around programmatic TV.
Yeah. It's interesting, that there's been a narrative about consolidation in this space, and obviously yesterday Rubicon announced their third quarter, and it was pretty awful, and they're laying off 19%, and it's like a flat guidance for the year. But I'm just wondering, are we, with the advent of like header bidding and all that stuff that's kind of like it's prevalent at the minute, are we going to see consolidation in some parts, particularly on the supply side? I mean, there's a lot of companies who are working with various vendors or various publishers, like particularly in London and elsewhere, and there seems to be like 6, 7 who've got header bidding technology, but it seems to me that there's going to be some kind of convergence on that side or sort of consolidation. Do you think that's likely to happen this year, next year?
It's a great question because I do think that the parties that play in and around the sort of exchange to supply side are probably the ones who are the most threatened by header bidding, and you're seeing it in their performance. Both the public companies, and some of the private companies that we talk to. I mean, they're all seeing their business. Growth has become harder. So you probably will see some consolidation. I think that the question is going to be from whom, and I think that as you see some of the new platforms emerge, and I think you and I have talked about this before, some of the private equity-backed ones, they may be a good home as businesses get built in the private markets that can eventually become public markets again. So, Rubicon probably would be better off right now if they were a private company going through some of these evolutions than they are as a public company.
Do you think that it's an interesting question, though? I mean, a lot of talk about various companies IPO, but do you think that ad tech should be public? I mean, like, we look at Criteo, right? Criteo are absolutely smashing it. They've quarter-on-quarter growth, but like, they're an exception. I mean, Trade Desk are obviously public as well, but a lot of the ad tech companies that have gone public have been, they've performed pretty badly.
Yep.
So is it that ad tech should really be a private entity? And it's almost like when independent ad tech is tough, right? But when it's bolted into a media company, it becomes kind of interesting. It's a bit like XML, right? If you're a program, XML is just rubbish in its own. But with Java, the
Right.
magic really happens, you know. So like ad tech is sort of like dark matter, right? It holds the whole world together. So do you think that we should be building companies to sell to big media companies, and that's the natural
Yeah.
home for this? Like,
Yeah, look, I think I've got a whole bunch of things running through my
there's
head.
a lot of things
I
going
got
on
a
there.
whole bunch
Sorry
of things
about
running
that.
through my head right now. So the answer to the first part is, look, I think there is a place for in the public markets for these companies. I'm not sure that having a public DSP or a public SSP makes sense, but maybe it's a public solution. Look, there's exceptions. Criteo is a great exception. But for instance, some of the other companies that have been out there, it's hard to run this business where you're essentially showing your customers your margins, right? And they go like, well, I'm paying too much. You guys are taking too much of the dollar, and so you're going to see some pressure. And so when you've got a public company that's got to be transparent, and so have disclosure obligations, and B, guide and report to the street every quarter, that's hard because these aren't businesses that do not have a lot of visibility. And so, I think a lot of these companies have a nice view of their business on a year-to-year basis, but maybe not on a quarter-to-quarter basis. And that's fine. As a private company, that's fine. As a public company, that's a lot harder place to be when you're giving guidance on an earnings call and you've got research analysts, writing about your stock.
asking really stupid questions as well. I was on the areas called like dumb questions, like only Wall Street people could ask.
So, thank you.
You're not technically Wall Street. So.
So I think that's why it's been hard for these companies. And like I said, some of these companies didn't go public by choice. I mean, they had some investors that basically said, we need some shot at liquidity here. But I do think there is a place for a more holistic solution that can capture add greater value across the ecosystem than I think the companies that are out there today. I mean, Criteo has been successful because look, they've had a bunch of good quarters, but more importantly, deliver a result to customers, and so people keep coming back. I think the other, and there isn't another public retargeting business out there. You got Tremor and Yumi doing essentially the same thing.
So when you talk about private equity, buying these companies, right? And since private equity looks at EBITDA, and some of these companies are still making losses as public companies. So what's the rationale between a private equity of private equity taking some of these private, taking them off the market into private? What are they looking to build something bigger? Because I'm curious, because this could be one of the big themes this year. Like ad tech is still very strategic, and there's a lot of active buyers, particularly in the media business. So there's an opportunity to take some of these and do a roll up, and then rebuild them and cut costs. So what's the sort of rationale behind that? Like if they can't, build on EBITDA, what's the sort of thinking there from a PE firm?
Yeah, so it's a good question because I would say there's been three or four good platform acquisitions by private equity of companies in the MarTech or ad tech space. Right, you've got MediaOcean, which was a profitable business. So there you had EBITDA there. You had Marketo, which wasn't profitable, but the private equity firm could see going in how they can make it profitable, and I'll come back to that in 1 second. And then you had Seismic, which was marginally profitable.
Very strategic asset, though.
But strategic, and also again one where the buyer saw a path of how you can make it, make it a profitable company. It's a lot easier to do that in the private markets. You talked about Rubicon laying off 20% of the workforce. Stocks can go one direction when you make that announcement. For the most part, I think when you're doing that as a private company, then that's who cares? I mean, nobody's out there if you're sort of looking at it as a turnaround, and I think that's how folks are thinking about that one. In addition to being strategic, so those are good platforms. And I'd say the other thing is you talk to some of these private equity firms. There's certain pockets of debt financing out there that are frankly easy, and so they're able to get even without the EBITDA. They can either show a pro forma EBITDA story and get financing, or frankly just these lenders are eager to deploy capital, and so have a good relationship with these firms. So I think the companies for the most part that are going to be taken private or have private equity buy it are going to be ones that are have some profitable profile, or there's a way to get them profitable. I'd say that frankly, some of the public companies out there that may not be profitable are now, if you look at it on a enterprise value, are so small, you look net of cash, that they can be tuck-ins for some of these other things that have already been acquired. And that's where I think you're going to see. You're going to see the platform acquisitions by private equity, which are these bigger acquisitions like the MediaOcean we talked about, or Francisco with Syntech, or things like that, which I hadn't mentioned before, but that was a very profitable business. But then the add-ons on top of that, right? So, and that doesn't require the same level of EBITDA. They're not going to get the same multiple for the business because it's not it's not a platform, but it is an exit for some of these companies to become a add-on to a platform acquisition.
Well, why now though? I mean, like they've ignored it for a while, but what is it? Just a case of like following the herd? One does it and then they're all in, or is it the case that they've all sat around the table going, well, this part of this industry is completely undervalued because actually it's the monetization, and we've got Snapchat, we've got all these other companies that are going to need ad tech at some stage to kind of monetize their audiences, etc. Is that the sort of thinking that they're sitting around going, that would work well there type of thing?
Yeah, I mean, a lot of these terms are thesis driven, and they look at markets that excite them, particularly markets that they think are growing markets with undervalued assets. Right, that's the holy grail, and you're seeing a lot of that. So they see an opportunity to buy businesses. Seismic was pretty cheap.
Yeah, very cheap.
But in a market that's highly strategic, again, going back to the beginning of our conversation, or why is there M&A activity in this market? It's because that's where the money is, right? It's like, why do people rob banks? That's where the money is. And so
you said ad tech's like a bank.
No, but I think digital marketing is where advertisers are deploying their capital.
So there's been a lot of interesting acquisitions this year, particularly from the Chinese, like a Chinese chicken company bought it was a Chinese chicken company, I think, bought some piece of tech there recently.
Highly strategic.
Yeah, I mean, what's the? I mean, everybody in this room is hoping a Chinese concrete company just arrives today and put a checkbook and say, like, "I'm by your company." But what's the thinking there for the Chinese? Well, I just find it fascinating. I think this is brilliant. Like, ad tech now has Chinese buyers, and it's some random insulation company in Southern China, like.
Yeah, top of every conversation, and it's funny because it's not. It's not Alibaba and Tencent, right? It's
it's random.
It's mining companies,
Yeah.
and look, I think there's two phases to it. The first phase is, and it's unlike PE, but it's also similar in thinking. So the first is these public companies trading stupid multiples on their exchanges in China, and what they need is more cash flow, more cash flow, and so they're looking. Okay, here's an undervalued market, and if you arbitrage, we're trading at 20 times EBITDA, and we can buy something for 10 times EBITDA, and we get the credit for that in our cash flow, because we're a big company, and it's a small part of it. Well, that's going to increase our market capitalization a fair amount. So, the first step of it is essentially an arbitrage play.
Yeah.
It's a financial engineering, at least for the most part of what we've seen, which is why chicken companies are buying, technology companies are...
Chicken company buying ad tech, like an ad server.
But
right?
so the Chinese businesses are scouring, the market, trying to find companies. But cash flow, and really not even EBITDA, but net income has been very important to them. And so
they're buying an EBITDA, but so why don't they just pick up so you're telling me, Josh, I should come to New York, set up an ad network, make loads of cash, bring like media, and then I should sell to a Chinese, chicken company.
Well, I mean, I would point you to talk to Div at media.net and the guys at Smato. I mean, or Apple. I mean, they weren't that dissimilar, to those businesses.
Are these boys more? Are we going to see more strategic stuff as opposed to just?
Well, so that's where I was saying step two,
Yeah.
right? So that's step one. I think is more of a financial engineering play. I do believe that having talked to some of these companies, because they're keeping the management team there. These, it's not like a typical strategic buyer where the management team leaves and they're left holding the bag. They need these teams because these. You know how to run a poultry farm, but not necessarily an ad exchange. And so these guys are out there, and they're looking for add-ons so to some extent, it looks like private equity, where you're then going to go out and try to buy the add-ons to these, quote-unquote platform acquisitions.
But are the Chinese seeing like opportunity? Like, I mean, the Smato was interesting because it was a mobile SSP, and
notice like maybe one, but very few of these deals have actually closed. I mean, Smato hasn't closed yet.
It hasn't closed.
Nope.
Really? Okay, poor Smato. Money's not in your account.
Or all of them. I mean, between the process, that's the downside of the Chinese. It's a long process. There's a lot of steps, and then you've got many levels of regulatory review. So, I mean, everything's done, but they're still in regulatory review. Okay. I think Opera may have closed on the the browser business, but I don't think any of the others have closed yet.
But do you think that even if it does close, they're looking to buy that to bring it into their own market, or are they looking to expand outside the Chinese market? Because obviously the Chinese ad market is exploding; it's huge.
Yeah, there's some of both. There's some of both, but obviously it's not a strategic buy per se in that, there's no synergy on day one, for owning this. I mean, it becomes more like a holding company, or conglomerate, right, where you have holdings, in media, farming, mining, you name it. I mean, making up things, but it's not a strategic buy per se. It begins as a financial play, but I do believe that there's a strategic roadmap driven by the execs who are the sellers.
So looking at the landscape over the next 12 months, obviously we're in November now, but like looking at next year, what do you see as the sort of key areas in the M&A landscape? What do you think are going to be the big themes next year?
I think there's going to be a continuation of the activity by the telcos. I think there's a lot of them out there continuing to look at businesses, continuing to decide whether they want to be in the sector. I think you're going to see publishers looking at, and I know we've talked about that comes up every year.
Yeah.
But
do they have money, publishers? You mean like media businesses, like TV businesses, etc.
TV, well, but even some traditional publishers. Again, with a similar thesis, albeit on a smaller scale. I mean, they're not going to buy the $500 million company, but they may try to do $75 million acquisitions of businesses in the space. Again, with similar rationale with data, O&O content or inventory. So you can see some publisher activity, and then I think you're going to see I think you're going to see the private equity activity next year as they try to continue to acquire platforms and consolidate the sector to build what I think is more end-to-end, which as I said earlier, I think it would be a more successful public company story than we have today.
So more sort of fill that proposition as opposed to sort of like a point solution.
Exactly.
Josh, thanks very much. Thanks for that insight, and particularly like the insight with the Chinese chicken company. So thank you very much. Round of applause for Josh, please.